last few years were exceptional, we have to say. Many governments were, in a way, forced to cushion the effects of this drastic recession with a high amount of uncertainty.
All the recovery and all the good signs that we see at the moment also crucially hinge on the ECB, really providing almost unlimited liquidity to the financial system.
If we would not have had monetary union over the last 12 years, I'm pretty sure that it would be very, very high on the agenda in Europe now.
For all the highly indebted countries, the adjustment will take a few years, especially if we look at Greece, of course.
Greece, I think we clearly see that they do not have a growth perspective whatsoever at the moment.
Greece has a lot of potential for attracting international investment. You could look, for example, at the tourism sector. If you opened the market and if you created an environment where property rights are clear, where taxes are fairly low, where you provide land also for development, I think a lot could happen.
The letter that Jens Weidmann sent the other week to Mario Draghi is so significant because it really is a question and puts a question on the table asking about, how far can we go? How much collateral can we really accept? When the ECB stops acting, things will get bad very quickly, and then we will talk about a breakup at some stage.
These budget cuts are necessary. In the medium term, they are indispensable in order to regain the sustainability of fiscal policy.
We need a debate on a fiscal federation, on a true transfer of sovereignty to Europe. If we see a big election outcome that puts in place a very anti-European party in some big countries, this would mean a significant setback.
The quicker and the more forceful you go at consolidation, the better.
The fiscal compact is a political signal that you want to go in this direction, but it's clearly not at all what is needed. You need, Brussels, a parliament in Brussels, to have actual tax authority and be able to raise taxes in order to finance bond, in order to backstop the financial system.
The Greek way of stretching this pain over now 4 years is nothing I would recommend.
More sovereignty, more power to Brussels means less power at the national level. And that includes the German, the French, the Dutch. It's hard for everybody to give up sovereignty.
Presently, everything is about regaining confidence on capital markets, cutting budgets, and doing crisis management.
We need the innovation reform. We need the labor market reforms. We certainly need the R&D policy. We need more mobility within Europe. All this I think is correct.
In the long term, we will have to find ways to invigorate the growth of employment.
Our real problem is really a problem of the institutional governance setup, and I think there we need to move, and that Europe 2020 does not really address.
What would have happened if we didn't have monetary union in Europe? We had very important shocks over the last 12 years. We had the bursting of the dot-com bubble. We had September 11, and we had the financial crisis in 2008-9. Can you imagine what kind of exchange rate volatility, overshooting, undershooting we would have had?
The cost of such a dissolution would be so apparent and would be so high and so disastrous if this type of dissolution scenario became politically acceptable, and if markets start seeing it, the policymakers would see the dramatic effects this would have. Maybe big countries that would exit the Eurozone would be cut off from capital markets immediately. There will be multiple sovereign defaults, and the banking system will be almost wiped out. You will see what you're seeing in Greece already, an exodus of capital. Governments have accepted becoming dependent on capital markets. The crisis has shown that this doesn't work anymore, that in order to get investors to buy your bonds, you need to create confidence in the sustainability of your finances, and that is something many governments missed.